So we are live everywhere, and let's begin. Hi, Unknown. Hi, Pure Loving. Welcome. So let me know your names, where you're from. Today we are doing the Alchemy of Finance. We are doing Chapter 2, Reflexivity in the Stock Market. Chapter 2 of the Alchemy of Finance by George Soros. My name is May Duldalau. The blog is yesfinanciallyfree.com. Thank you so much for being here today. A little bit about myself. I live in Honolulu, Hawaii with my son, Jordan. He's 7 years old, and my husband, Jamel. We live in Waikiki. We own this condo. We own another one down the road, which is an Airbnb. Back in 2011, I was really bad with money. I didn't own any property, okay? And I had over $40,000 of debts. Now, debts is like 8 different credit cards, lines of credit, so pretty bad consumer debt. And I ended up paying it all off by April 2016. But not only that, I improved our family's net worth by $500,000, making almost $500 a month in passive income. And I quit my job. I was working at a local bank. I quit December 23rd, 2016 was my last day. I became a full-time mother and wife, homemaker, part-time finance freedom coach. I created a business called Finance Freedom Mastermind, where I coach clients on how to do what I did, which is not only pay off debt, but increase your wealth at the same time, in addition to passive income, so that you can become financially free as quickly as possible. Hi, Mykar. Welcome to the live. Let me know your names and where you're from. So today, I am going to read from a book. And this book is George Soros' book. George Soros. Oh, and if you're not already on my email list, go to yesfinanciallyfree.com. San Francisco. Michael, we have someone from San Francisco on. Thanks for being on, Mykar. Nice to meet you. From San Francisco. Okay, you can always tap the screen. Give me some hearts. Love the hearts. And I do follow back. People give me lots of hearts. Okay, so yesfinanciallyfree.com. If you're not on the email list yet, go there, put in your first name, email address. You will get the free ebook, Working Parents Guide to Financial Freedom, sent directly to your inbox. And you will get emails. I sent an email just before I went live telling everyone what I was going to be doing, and also a link to the blog post so they can catch the replay and the summary whenever they want. So it's great to be on the email list. You get great deals, great information. You're the first to know what I'll be talking about. So yesfinanciallyfree.com also has years and years of blog posts, right? So if you want to know, my story, how did I quit my job? How did I do how do I make passive income? All that information is at yesfinanciallyfree.com, okay? And I just want you to know that when I quit my job, my son was 3 years old. Okay, so I am a mother, and I found a way as a working parent to improve my lifestyle, and I want you to do the same. Okay, so let's jump right into today's topic, and we are doing reflexivity in the stock market. Now, I don't actually know what this chapter is about because I haven't read it, so I'm going to read it with you. So today is a reading day. So this is the book, Alchemy of Finance, all right, by George Soros, all right? So that's what we're doing today. I hope you guys are excited. I'm excited. I'd like to learn. If you don't know who George Soros is, he's a billionaire, one of the best technical investors ever. He has shorted the English pound in 1992, made $1 billion profit from that short. And he made his profit on Black Wednesday, which was a currency crisis in England. So he's a very interesting person, and he has a theory in investing. And he says his theory, which he calls reflexivity. Want to be an underwriter? I'm 18. Is that a good choice starting off in my career? Whatever you want to do, you have to figure that out in your own heart. But that's a good question. All right, someone asked me. I cannot tell you what is a good choice of career. Only you know that in your heart. If you calm down and ask yourself, is this something I want to do? Is this a good career for me? And you will know. Okay, so in the end, you're the only one who can decide that. All right. Who if I asked someone when I was graduating if I could be an internet marketer and tell people how to create passive income so they can have more free time and be with their children, I'm sure the person would have no idea how to answer my question. Okay, so it is only you who can decide what you can do with your career, all right? No one else, because you make your own success. You know what you love to do, okay? I'm just going to throw that out there before we start, okay? Let's begin, all right? So I'm going to learn from a billionaire. I hope you guys enjoy it. Let's start. So his theory is reflexivity, okay? Now, chapter 1, I did a summary of chapter 1 last week on Friday. So if you missed that, go to the blog, financiallyfree.com, and just go and check the summary. But basically, his theory is that people are the ones who create the stock market and all the value in it. People are not perfect. I'm a person, right? I make a decision. I make a financial decision. I buy something. I spend money. I whatever, right? That influences the economy, right? Because I spent money or I made money, and then hence I'm a member of this economic system. And because I'm a person, I'm not perfect. So whatever I think is going on, I'm acting from that. That may or may not be true. All right. So that's the basis of his whole theory, reflexivity, is that it's not perfect. And the people involved in the process of creating wealth, money, the economy, they are acting on imperfect knowledge that's always different, that's always changing. Okay. And we have to acknowledge that. All right. So how does he do that? So let's do it. In trying to develop a theory of reflexivity, I shall start with the stock market. For one thing, it is the market I am most familiar with. I have been a professional investor for more than 25 years. For another, the stock market provides an excellent laboratory for testing theories. Changes are expressed in quantitative terms, and the data are easily accessible. Even the participants' views are usually available in the form of brokers' reports. Most important, I have actually tested my theory in the stock market, and I have some interesting cases to present. So this will be fun. As I mentioned in the introduction, I did not develop my ideas on reflexivity in connection with my activities in the stock market. The theory of reflexivity started out as an abstract philosophical speculation, and only gradually did I discover its relevance to the behavior of stock prices. I was singularly unsuccessful in formulating my theory at the level of abstraction at which I conceived it. My failure as a philosopher stands in stark contrast with my career as an investment professional. I hope that by presenting my ideas in the reverse order from the one in which I arrived them, I may be able to avoid getting lost in arcane abstractions. There is yet another reason why the stock market may provide the best entry point for the study of reflexive phenomena. The stock market comes as close to meeting that criteria of perfect competition as any market. A central marketplace, homogeneous products, low transaction and transportation costs, instant communications, large enough crowd of participants to ensure that no individual can influence market prices in the ordinary course of events, and special rules for insider transactions, as well as special safeguards to provide all participants with access to relevant information. What more can one ask for? Is there any place where the theory of perfect competition ought to be translated into practice? It is in the stock market. Yet there is little empirical evidence of an equilibrium or even a tendency for prices to move toward an equilibrium. The concept of an equilibrium seems irrelevant at best and misleading at worst. The evidence shows persistent fluctuations, whatever length of time is chosen as the period of observation. Admittedly, the underlying conditions that are supposed to be reflected in stock prices are also constantly changing, but it is difficult to establish in any firm relationship between changes in stock prices and changes in underlying conditions. Whatever relationship can be established has to be imputed rather than observed. I intend to use the theory of reflexivity to criticize the preoccupation of economic theory with the equilibrium position. What better example could I find than the stock market? Existing theories about the behavior of stock prices are remarkably inadequate. They are of so little value to the practitioner that I am not even fully familiar with them. The fact that I could get by without them speaks for itself. Generally, theories fall into two categories, fundamentalist and technical. More recently, the random walk theory has come into vogue. This theory holds that the market fully discounts all future developments so that the individual participants' chances of over or underperforming the market as a whole are even. This line of argument has served as theoretical justification for the increasing number of institutions that invest their money in index funds. The theory is manifestly false. I have disproved it by consistently outperforming the averages over a period of 12 years. Institutions may be well advised to invest in index funds rather than making specific investment decisions, but the reason is to be found in their substandard performance, not in the impossibility of outperforming the averages. Technical analysis studies market patterns and the demand and supply of stocks. It has undoubted merit in predicting probabilities, but not the actual course of events. For the purposes of this discussion, it is of no particular interest because it has little theoretical foundation other than the assertions that stock prices are determined by their supply and demand and that past experience is relevant in predicting the future. Fundamental analysis is more interesting because it is an outgrowth of equilibrium theory. Stocks are supposed to have a true or fundamental value as distinct from their current market price. The fundamental value of a stock may be defined either in relation to the earning power of the underlying asset or in relation to the fundamental value of other stocks. In either case, the market price of a stock is supposed to tend toward its fundamental value over time, so that the analysis of fundamental values provides a useful guide to investment decisions. The important point about this approach is that the connection between stock prices and the companies whose stocks are traded is assumed to be in one direction. The fortunes of the companies determine, however belatedly, the relative values of the various stocks traded in the stock market. The possibility that the stock market developments may affect the fortunes of the companies is left out of account. There is a clear parallel with the theory of price, where the indifference curve determines the relative amounts consumed, and the possibility that the market may influence the indifference curve is discarded. The parallel is not accidental. The fundamentalist approach is based on the theory of price, but the omission is most glaring in the stock market than in other markets. Stock market valuations have a direct way of influencing underlying values through the issue and repurchase of shares and options, and through corporate transactions of all kinds, mergers, acquisitions, going public, going private, and so on. There are also more subtle ways in which stock prices may influence the standing of a company: credit rating, consumer acceptance, management credibility, etc. The influence of these factors on stock prices is, of course, fully recognized. It is the influence of stock prices on these factors that is so strangely ignored by fundamentalist approach. If there are any glaring discrepancies between prevailing stock prices and fundamental values, they are attributed to future developments in the companies concerned that are not yet known, but are correctly anticipated by the stock market. Movement in stock prices are believed to precede the developments that subsequently justify them. How future developments ought to be discounted is the subject of an ongoing debate, but it is presumed that the market is doing the job correctly, even if the correct method cannot be theoretically established. The point of view follows naturally from the theory of perfect competition. It is summed up in the assertion that the market is always right. The assertion is generally accepted, even by people who do not put much faith in fundamental analysis. I take a totally opposite point of view. I do not accept the proposition that stock prices are a passive reflection of underlying values, nor do I accept the proposition that the reflection tends to correspond to the underlying value. I contend that market valuations are always distorted. Moreover, that this is the crucial departure from equilibrium theory. The distortions can affect the underlying values. Stock prices are not merely passive reflections. They are active ingredients in a process in which stock prices and the fortunes of the companies whose stocks are traded are determined. In other words, I regard changes in stock prices as part of a historical process, and I focus on the discrepancy between the participants' expectations and the actual course of events as a causal factor in that process. To explain the process, I take the discrepancy as my starting point. I do not rule out the possibility that events may actually correspond to people's expectations, but I treat it as a limiting case. Translating this assertion into market terms, I claim that market participants are always biased in one way or another. I do not deny that markets have a predictive or anticipating power that seems uncanny at times, but I argue that it can be explained by the influence that the participant's bias has on the course of events. For instance, the stock market is generally believed to anticipate recessions. It would be more correct to say that it can help to precipitate them. Thus, I replace the assertion that markets are always right with two others. Markets are always biased in one direction or another. Markets can influence the events that they anticipate. The combination of these two assertions explains why markets may so often appear to anticipate events correctly. That's really funny. The combination... Okay, actually, that's pretty funny stuff. Using the participant's bias as our starting point, we can try to build a model of the interaction between the participants' views and the situation in which they participate. What makes the analysis so difficult is that the participants' views are part of the situation to which they relate. To make any sense of such a complex situation, we need to simplify it. I introduced a simplifying concept when I spoke of the participant's bias. Now I want to take the argument a step further and introduce the concept of a prevailing bias. Markets have many participants whose views are bound to differ. I shall assume that many of the individual biases cancel each other out, leaving what I call the prevailing bias. This assumption is not appropriate to all historical processes, but it does apply to the stock market and to other markets as well. What makes the procedure of aggregating individual perceptions legitimate is that they can be related to a common denominator, namely stock prices. In other historical processes, the participants' views are too diffuse to be aggregated, and the concept of a prevailing bias becomes little more than a metaphor. In these cases, a different model may be needed. But in the stock market, the participant's bias finds expression in purchases and sales. Other things being equal, a positive bias leads to rising stock prices and a negative one to falling prices. Thus, the prevailing bias is an observable phenomenon. Other things are, of course, never equal. We need to know a little more about those other things in order to build our model. At this point, I shall introduce a second simplifying concept. I shall postulate an underlying trend that influences the movement of stock prices, whether it is recognized by investors or not. The influence on stock prices will, of course, vary depending on the market participants' views. The trend in stock prices can then be envisioned as a composite of the underlying trend and the prevailing bias. Okay, so how do these two factors interact? It will be recalled that there are two connections at play, the participating and the cognitive functions. The underlying trend influences the participants' perceptions through the cognitive function. The resulting change in perceptions affects the situation through the participating function. In the case of the stock market, the primary impact is on stock prices. The change in stock prices may in turn affect both the participant's bias and the underlying trend. We have here a reflexive relationship in which stock prices are determined by two factors, underlying trend and prevailing bias, both of which are in turn influenced by stock prices. The interplay between stock prices and the other two factors has no constant. What is supposed to be the independent variable in one function is the dependent variable in the other. Without a constant, there is no tendency toward equilibrium. The sequence of events is best interpreted as a process of historical change in which none of the variables, stock price, underlying trend, and prevailing bias, remains as it was before. In the typical sequence, the three variables reinforce each other first in one direction and then in the other in a pattern that is known in its simplest form as boom and bust. First, we must start with some definitions. When stock prices reinforce the underlying trend, we shall call the trend self-reinforcing. When they work in the opposite direction, self-correcting. The same terminology holds for the prevailing bias. It can be self-reinforcing or self-correcting. It is important to realize that what these terms mean. When a trend is reinforced, it accelerates. When the bias is reinforced, the divergence between expectations and the actual course of future stock prices gets wider, and conversely, when it is self-correcting, the divergence gets narrower. As far as stock prices are concerned, we shall describe them simply as rising and falling. When the prevailing bias helps to raise prices, we shall call it positive. When it works in the opposite direction, negative. Thus, rising prices are reinforced by a positive bias and falling prices by a negative one. In a boom-bust sequence, we would expect to find at least one stretch where rising prices are reinforced by a positive bias and another where falling prices are reinforced by a positive bias, by negative bias. There must also be a point where the underlying trend and the prevailing bias combine to reverse the trend in stock price. Let us now try to build a rudimentary model of boom and bust. We start with the underlying trend that is not yet recognized, although a prevailing bias that is not yet fully reflected in stock prices is also conceivable. Thus, the prevailing bias is negative to start with. When the market participants recognize the trend, the change in perceptions will affect stock prices. The change in stock prices may or may not affect the underlying trend. In the latter case, there is little more to discuss. In the former case, we have the beginning of a self-reinforcing process. The enhanced trend will affect the prevailing bias in one or two ways. It will lead to the expectation of further acceleration or to the expectation of a correction. In the latter case, the underlying trend may or may not survive the correction in stock prices. In the former case, a positive bias develops, causing a further rise in stock prices and a further acceleration in the underlying trend. As long as the bias is self-reinforcing, expectations rise even faster than stock prices. The underlying trend becomes increasingly influenced by stock prices, and the rise in stock prices becomes increasingly dependent on the prevailing bias, so that both the underlying trend and the prevailing bias become increasingly vulnerable. Eventually, the trend in prices cannot sustain the prevailing expectations, and a correction sets in. Disappointed expectations have a negative effect on stock prices, and faltering stock prices weaken the underlying trend. If the underlying trend has become overly dependent on stock prices, the correction may turn into a total reversal. In that case, the stock prices fall and the underlying trend is reversed, and expectations fall even further. In this way, a self-reinforcing process gets started in the opposite direction. Eventually, the downturn also reaches a climax and reverses itself. Typically, a self-reinforcing process undergoes orderly corrections in the early stages. And if it survives them, the bias tends to be reinforced and is less easily shaken. When the process is advanced, corrections become scarcer and the danger of a climactic reversal greater. I have sketched out a typical boom-bust sequence. It can be illustrated by two curves that follow more or less the same direction. One represents stock prices and the other earnings per share. It would be natural to envision the earnings curve as a measure of the underlying trend, and the divergence between the two curves as the indication of the underlying bias. The relationship is much more complex. The earnings curve incorporates not only the underlying trend, but also the influence of stock prices on that trend. The prevailing bias is expressed only partially by the divergence between the two curves. Partially, it is already reflected in those curves. Concepts that are only partially observable are extremely difficult to work with. That is why we have chosen variables that can be observed and quantified, although, as we shall see later, the quantification of earnings per share can be very misleading. For present purposes, we shall assume that the fundamentals in which the investors are interested are properly measured by earnings per share. Typical path for the two curves may be as follows. See figure on page 56. This is the figure on page 56. So that you can see that, what it looks like. There it is. There's the figure. Okay. At first, recognition of the underlying trend is lagging, but the trend is strong enough to manifest itself in earnings per share, AB. So let's see, earnings per share, AB, okay. When the underlying trend is finally recognized, it is reinforced by rising expectations, BC. Okay, doubts arise, but the trend survives. Alternatively, the trend wavers but reasserts itself. Such testing may be repeated several times, but here I show it only once in CD. Okay. Eventually, conviction develops and is no longer shaken by a setback in the earnings trend, DE. Expectations become excessive and fail to be sustained by reality, EF. The bias is recognized and expectations are lowered, FG. Stock prices lose their last prop and plunge in G. The underlying trend is reversed, reinforcing the decline, GH. Eventually, the pessimism becomes overdone and the market stabilizes, HI. It should be emphasized that this is only one possible path that results from the interplay of a single underlying trend and a prevailing bias. There could be more than one trend at work, and the prevailing bias could have many nuances, so that the sequence of events may require a totally different representation. But basically, it starts out with, this price being low, okay, and the earnings being, earnings being the same. He puts earnings as the same as price. Then the earnings get higher than the price, and then people start seeing that, and they start buying the stock because the earnings are higher than the price. And then what happens is you have this bump up, and then there's a correction, right? It's a correction, but it survives. It survives that correction. It goes up. Now it becomes removed from reality. It just shoots to the sky, and then it comes back down, and it goes below earnings because people are pessimistic now, unrealistically pessimistic, boom, going below earnings, and then it starts to balance out. Okay. A few words about the theoretical construction of the model may be in order. We are interested in the interplay between the participant's bias and the actual course of events. Hi, Bob. Welcome. Yet the participant's bias is not directly represented in our model. Both curves denote the actual course of events. The prevailing bias is partially incorporated in the two curves and partially denoted by the divergence between them. The great merit of this construction is that it uses variables that can be quantified. Stock prices serve as a convenient proxy for the situation to which participants' bias relates. In other historic processes, the situation that is interconnected with the participant's perception by the cognitive and participating functions is more difficult to identify and impossible to quantify. It is the availability of a convenient proxy that renders the stock market such a useful laboratory for studying reflexivity. Fortunately, the model offers only a partial explanation of how stock prices are determined. The concept of an underlying trend has been introduced as a placeholder term to denote changes in the fundamentals. What the fundamentals are has not been defined. Even the question of how the fundamentals are to be measured has not been answered. Earnings, dividends, asset value, free cash flow, all these yardsticks are relevant, as well as many others, but the relative weight given to each depends on the investor's judgment and is therefore subject to their bias. We may use earnings per share for purposes of illustration, but that merely begs the question. It is a question security analysts have been struggling with for a long time. We do not need to answer it here in order to develop a theory of reflexivity. Without knowing anything about the fundamentals, we can make some worthwhile generalizations. The first generalization is that stock prices must have some effect on fundamentals, whatever they are, in order to create a boom-bust pattern. Sometimes the connection is direct, as in the examples I shall use in this chapter, but generally it is indirect. Often it makes its effect felt through a political process, such as changes in taxation or regulation or attitudes towards saving and investment. It is possible to have a reflexive connection between stock prices and the prevailing bias, even if the fundamentals remain unaffected. But the connection becomes interesting only if the fundamentals are also involved. Without a change in fundamentals, the prevailing bias is likely to be corrected in short order, as we can observe in the daily fluctuation of stock prices. It would be quite in order to ignore the bias as mere noise. That is what the theory of perfect competition and the fundamentalist approach to security analysis have done. By contrast, when fundamentals are affected, the bias cannot be left out of account without serious distortion, because the bias gives rise to a self-reinforcing, self-defeating process that leaves neither stock prices nor the fundamentals nor the participant views the same as they were before. The second generalization is that there is bound to be a flaw in the participant's perception of the fundamentals. The flaw may not be apparent in the early stages, but is likely to manifest itself later on. When it does, it sets the stage for a reversal in the prevailing bias. If the change in bias reverses the underlying trend, a self-reinforcing process is set in motion in the opposite direction. What the flaw is and how and when it is likely to manifest itself are the keys to understanding boom-bust sequences. The model I presented above is built on these two generalizations. It hardly needs emphasizing how crude the model is. Nevertheless, it is valuable in identifying the crucial features of a typical boom-bust sequence. There are unrecognized trends, the beginning of a self-reinforcing process, the successful test, the growing conviction, resulting in a widening divergence between reality and expectations, the flaw in perceptions, the climax, a self-reinforcing process in the opposite direction. Just by identifying these features, we can gain some insight into the behavior of stock prices. We cannot expect much more from our rudimentary model. In any case, a reflexive model cannot take the place of fundamental analysis. All it can do is provide an ingredient that is missing from it. In principle, the two approaches could be reconciled. Fundamental analysis seeks to establish how underlying values are reflected in stock prices, whereas the theory of reflexivity shows how stock prices can influence underlying values. One provides a static picture, the other a dynamic one. A theory that offers a partial explanation of stock price movements can be very useful to the investor, especially if it illuminates a relationship that other investors fail to grasp. Investors operate with limited funds and limited intelligence. They do not need to know everything. As long as they understand something better than others, they have an edge. The trouble with any kind of specialized knowledge is that one's area of expertise may not be especially interesting. But the theory of reflexivity serves to identify historically significant price movements, so it goes right to the heart of the matter. The rudimentary model I have outlined above has proved extremely rewarding in my career as an investor. That may seem surprising because the model is so simple, and it fits a well-trodden stock market pattern so well that one would expect every investor would be familiar with it. Yet, that is not the case. Why? Part of the answer must be that market participants have been misguided by a different theoretical construction, one derived from classical economics, and even more important, from the natural sciences. The imagined attitude is that stock prices are the passive reflection of some underlying reality and not an active ingredient in the historical process. This view is simply false. It is remarkable that the error has not been fully recognized. Nevertheless, investors do recognize the sequence I have described and do respond to it. Only they respond later than someone who's working with the appropriate model and is on the lookout for the crucial features that define the shape of the price curve. That is what has given me my edge. The first time I used the model systematically was in the conglomerate boom of the late 1960s. It enabled me to make money both on the way up and on the way down. Okay, the key to the conglomerate boom was a prevailing misconception among investors. Investors had come to value growth in per-share earnings and failed to discriminate about the way the earnings growth was accomplished. A few companies learned to produce earnings growth through acquisitions. Once the market started to reward them for their performance, their task became easier because they could offer their own highly priced stock in acquiring other companies. In theory, the process works as follows. Let us assume that all the companies involved have the same intrinsic growth in earnings, but the stock of the acquiring company sells at twice the earnings multiple of the acquired ones. If the acquired company manages to double its size, its earnings per share jump by 50%, and its growth rate increases accordingly. In practice, the early conglomerates started out with high intrinsic growth rates that were rewarded by high multiples. Several of the path breakers were high technology companies with a strong defense component whose managements recognized that their historic growth rate could not be sustained indefinitely. Textron, Teledyne, Ling Temco, Vault, LTV, not to mention a few. They started to acquire more mundane companies, but as their per-share earnings growth accelerated, the multiples expanded instead of contracting. Their success attracted imitators, and later on, even the most humdrum companies could attain a high multiple by going on an acquisition spree. For instance, the bulk of Ogden's earnings were derived from trading scrap metal. Nevertheless, the stock sold at more than 20 times earnings at its peak. Eventually, a company could achieve a high multiple just by promising to put it to good use by making acquisitions. Managements developed special accounting techniques that enhanced the impact of acquisitions. They also introduced changes that acquired companies, streamlining operations, disposing of assets, and generally focusing on the bottom line, but these changes were less significant than the impact on per-share earnings of the acquisitions themselves. Investors responded like Indians to firewater. At first, the record of each company was judged on its own merits, but gradually conglomerates became recognized as a group. A new breed of investors emerged, the so-called go-go fund managers, or gunslingers, who developed a special affinity with the managements of conglomerates. Direct lines of communication were open between them, and conglomerates would place so-called letter stock directly with investors. Eventually, conglomerates learned to manage their stock prices as well as their earnings. Events followed the sequence described in my model. Multiples expanded, and eventually reality could not sustain expectations. More and more people realized the misconception on which the boom rested, even as they continued to play the game. Acquisitions had to get larger and larger in order to maintain the momentum, and in the end, they ran into the limits of size. The climactic event was the attempt by Saul Steinberg to acquire Chemical Bank. It was fought and defeated by the establishment. When stock prices started to fall, the decline fed on itself. The favorable impact of acquisitions on per-share earnings diminished, and eventually it became impractical to make new acquisitions. The internal problems that had swept up under the carpet during the period of rapid external growth began to surface. Earnings reports revealed unpleasant surprises. Investors became disillusioned and managements went through their own crises. After the heady days of success, few were willing to buckle down to the burdens of day-to-day management. The situation was aggravated by recession, and many of the high-flying conglomerates literally disintegrated. Investors were prepared to believe the worst, and in some cases, the worst actually occurred. In others, reality turned out to be better than expectations, and eventually the situation stabilized with these surviving companies, often under new management, slowly working themselves out from under the debris. The conglomerate boom is particularly well suited to serve as an illustration of my rudimentary model because the fundamentals are readily quantified. Investors base their valuations on reported per-share earnings. However, meaningless the figures, they provide charts that closely conform to my theoretical prototype, and here they are. So he has charts here from the conglomerate boom bust, and it has the per share earnings and the price of the stock. And this is for LTV Corp. So, and it goes on the predictable up, and then down. So that's what he's saying. And then he's got Ogden Corporation right here. Ogden Corporation has the same kind of design, same. And then Teledyne Inc. Teledyne Inc. also has similar boom busting going on. And that's it there. Okay. My report had an interesting history. It came at a time when go-go fund managers had suffered severe losses in the collapse of the conglomerates. Since they were entitled to share in the profits but did not have to share in the losses of the funds they managed, they were inclined to grasp at anything that held out the prospect of a quick profit. They instinctively understood how a self-reinforcing process works since they had just participated in one, and they were anxious to play. The report found a tremendous response whose extent I realized only when I received a telephone call from a bank in Cleveland asking for a new copy because theirs had gone through so many Xerox incarnations that it was no longer legible. There were only a few mortgage trusts in existence at the time, but the shares were so eagerly sought after that they nearly doubled in price in the space of a month or so. Demand generated supply, and there was a flood of new issues coming to market. When it became clear that the stream of new mortgage trusts was inexhaustible, prices fell almost as rapidly as they had gone up. Okay, he's talking about a report he wrote. So, oh, I missed a section. Sorry, guys. Oh, here it goes. My best documented encounter with a boom bust sequence is that of real estate investment trusts. There we go. This is the part I missed. As they are called, are a special corporate form brought into existence by legislation. Their key feature is that they can distribute their income free of corporate taxation, provided they distribute all the income they receive. The opportunity created this legislation remained largely unexploited until 1969, when a large number of REITs were formed. I was present at the creation and, fresh from my experience with conglomerates, recognized their boom-bust potential. I published a research report whose key part read as follows. Okay, so he created a research report on real estate investment trusts when they were first created. The case for mortgage trusts, February 1970. The concept. Superficially, mortgage trusts seem to resemble mutual funds designed to provide high current yields, but the analogy is misleading. The true attraction of mortgage trusts lies in their ability to generate capital gains for their shareholders by selling additional shares at a premium over book value. If a trust with a book value of $10 and a 12% return on equity doubles its equity by selling additional shares at $20, the book value jumps to $13.32, and per share earnings go from $1.20 to $1.60. Investors are willing to pay a premium because of the high yield and the expectation of per share earnings growth. The higher the premium, the easier it is for the trust to fulfill this expectation. The process is a self-reinforcing one. Once it gets underway, the trust can show a steady growth in per share earnings despite the fact that it distributes practically all its earnings as dividends. Investors who participate in the process early enough can enjoy the compound benefits of high return on equity, a rising book value, and a rising premium over book value. Analytical approach. The conventional method of security analysis is to try and predict the future course of earnings and then to estimate the price that investors will be willing to pay for those earnings. This method is inappropriate to the analysis of mortgage trusts because the price that investors are willing to pay for the shares is an important factor in determining the future course of earnings. Instead of predicting future earnings and valuations separately, we shall try to predict the future course of the entire self-reinforcing process. We shall identify three major factors which reinforce each other, and we shall sketch out a scenario of the probable course of development. The three factors are the effective rate of return on the mortgage trust capital. 2, the rate of growth of the mortgage trust size. 3, investor recognition, i.e., the multiple investors are willing to pay for a given rate of growth in per share earnings. The scenario, Act 1. At present, the effective yield on construction loans is an optimum. Not only are interest rates high, but losses are at a relatively low level. There is a pent-up demand for housing, and new houses readily find buyers. There's a shortage of funds so that the projects which do get off the ground are economically well justified. Builders who are still in business are more substantial and more reliable than at the tail end of a boom. Moreover, they do their utmost to complete the construction phase as fast as possible because money is so expensive. Shortages of labor and material do cause defaults and delays, but rising costs permit mortgage trusts to liquidate their commitments without loss. Money is tight, and alternative sources of interim financing are in short supply. Investor recognition of the mortgage trust concept has progressed far enough to permit the formation of new trusts and the rapid expansion of existing ones. The self-reinforcing process gets underway. Act 2. If and when inflation abates, the effective yield on construction loans will decline. On the other hand, there will be a housing boom and bank credit will be available at advantageous rates. With higher leverage, the rate of return on equity can be maintained despite a lower effective yield. With a growing market and growing investor recognition, the premium over book value may continue to increase. Mortgage trusts are likely to take full advantage of the premium and show a rapid rise in both size and per share earnings. Since entry into the field is unrestricted, the number of mortgage trusts will also increase. Act 3. The self-reinforcing process will continue until mortgage trusts have captured a significant part of the construction loan market. Increasing competition will then force them to take greater risks. Construction activity itself will have become more speculative, and bad loans will increase. Eventually, the housing boom will slacken off, and housing surpluses will appear in various parts of the country, accompanied by a slack real estate market and temporary declines in real estate prices. At this point, some of the mortgage trusts will be bound to have a larger number of delinquent loans in their portfolios, and the banks will panic and demand that their lines of credits be paid off. Act 4. Investor disappointment will affect the valuation of the group, and a lower premium coupled with slower growth will in turn reduce the per share earnings progression. The multiple will decline, and the group will go through a shakeout period. After the shakeout, the industry will have attained maturity. There will be few new entries, regulations may be introduced, and existing trusts will settle down to a more moderate growth. Evaluation. The shakeout is a long time away. Before it occurs, mortgage trusts will have grown manifold in size, and mortgage trust shares will have shown tremendous gains. It is not a danger that should deter investors at the present time. The only real danger at present is that the self-reinforcing process may not get underway at all. It is in a really serious stock market decline. Investors may be unwilling to pay any premium, even for a 12% return on equity. We doubt that such conditions would arise. We are more inclined to expect an environment in which a 12% return is more exceptional than it has been recently, and in which the self-reinforcing processes of the past few years, notably conglomerates and computer leasing companies, are going through their shakeout period. In such an environment, there should be enough money available for a self-reinforcing process, which is just starting, especially if it is the only game in town. If the process fails to get underway, investors would find downside protection in the book value. The new trusts are coming to the market at book value plus underwriting commission, usually 10%. Most recently formed trusts are selling at a premium, which is still modest. It will be recalled that when their assets are fully employed in interim loans, mortgage trusts can earn 11% on their book without leverage and 12% with 1-to-1 leverage. A modest premium over book value would seem justified even in the absence of growth. If the self-reinforcing process does get underway, shareholders in well-managed mortgage trusts should enjoy the compound benefits of a high return on equity, a rising book value, and a rising premium over book value for the next few years. The capital gains potential is the same order of magnitude as at the beginning of other self-reinforcing processes in recent stock market history. And then he goes on about his report and how people wanted to read it. Nevertheless, their enthusiastic reception helped to get the self-reinforcing process described in the report underway. Subsequent events took the course outlined in the report. Mortgage trust shares enjoyed a boom that was not as violent as the ones that followed the publication of the report, but turned out to be more enduring. I had invested heavily in mortgage trusts and took some profits when the reception of my report exceeded my expectations, but I was sufficiently carried away by my own success to be caught in the downdraft with a significant inventory. I hung on and even increased my positions. I followed the industry closely for a year or so and sold my holdings with good profits. Then I lost touch with the group until a few years later when problems began to surface. I was attempted to establish a short position, but was handicapped in that I was no longer familiar with the terrain. Nevertheless, when I reread the report I had written several years earlier, I was persuaded by my own prediction. I decided to sell the group short, more or less indiscriminately. Moreover, as the shares fell, I maintained the same level of exposure by selling additional shares short. My original prediction was fulfilled and most REITs went broke. The result was that I reaped more than 100% profit on my short positions, a seeming impossibility since the maximum profit on a short is 100%. The explanation is that I kept on selling additional shares. Self-reinforcing and self-defeating cycles like the conglomerate boom and the REITs do not occur every day. There are long fallow periods when the specialist in such cycles remains unemployed. He need not starve, however. The divergence between underlying trends and investor recognition persists at all times, and the astute investor can take advantage of it. New industries arise or old ones come back into favor. Typically, they are inadequately followed at first. For instance, when defense spending started to rise in the early 1970s after a long decline, there were only 2 or 3 analysts left who followed the industry, although it still represented a substantial portion of the economy. Those who were left were too demoralized to recognize the beginning of a major new trend. That was a wonderful time to invest in defense stocks. There were high-tech defense stocks that had never been visited by an analyst like E-Systems Inc., and well-established companies that had fallen on evil days trying to diversify out of defenses like Sanders Associates, or getting caught up in scandals trying to sell airplanes through bribery like Northrop and Lockheed. In the case of defense stocks, there was no self-reinforcing process involved, but investor recognition certainly helped the price of the stocks. Actually, it is a rare case where the investor's bias leaves the fundamentals totally unaffected. Even with defense stocks, the prevailing bias played a role, but it was a negative one. Lockheed had to be bailed out by the government, and companies like Sanders Associates had to restructure their debt by offering convertible bonds at prices that turned out to be very low in retrospect. Only when the negative bias was corrected was there very little further feedback. Companies had little need for additional capital, and managements, having been burned once before, were leery of diversifying out of defense. There were exceptions like United Aircraft, but investors' bias never turned positive enough to allow a self-reinforcing process to get underway. Many of United Aircraft's acquisitions were for cash, and those that involved stock did not enhance earnings significantly. The result was a larger diversified company, but no boom bust in the stock. Perhaps the most interesting case of negative bias occurred in technology stocks. After the stock market debacle of 1974, investors were leery of any company that needed to raise equity capital from outside sources. Distributed data processing was in the early stages of its development. New companies like DataPoint and 4Phase were in the vanguard, with IBM lagging badly. The market was practically exploding, but these little companies were hamstrung by their inability to raise capital. The stocks were selling at very low multiples of anticipated earnings, and the main argument against them was that they would not be able to grow fast enough to meet demand, and eventually IBM would move into the market. The argument turned out to be valid, but not before these companies became large and prosperous, and investors became eager to throw money at them at high multiples. Those who had been willing to fight the negative bias were amply rewarded. As the various niches occupied by these small companies converged to form a large market, most of them were absorbed by larger companies, and those that stayed independent fell on evil days. DataPoint is currently looking for a home at a much reduced multiple. 4Phase was recently acquired by Motorola, which proceeded to lose its shirt on it. If the initial market reaction to distributed data processing companies had been more positive, it is possible that some of the early starters might have grown fast enough to survive, just as the earlier wave of microcomputer manufacturers did spawn a few enduring companies like Digital Equipment and Data General. The negative bias of the 1975-1976 period gave way to the opposite extreme. It found expression in a venture capital boom that culminated in the second quarter of 1983. The sequence of events is not as clear-cut as in the case of REITs, real estate investment trusts, but that is only because high technology is not as homogeneous an industry. The same reflexive interaction between stock prices, prevailing bias, and fundamentals can be observed, but much more specific knowledge is required to trace the course of events. The availability of venture capital on attractive terms led to a proliferation of new ventures. Every new company needed equipment as well as inventory, so that electronic equipment manufacturers enjoyed a boom, and so did the manufacturers of products and components. The electronics industry is a large customer of its own products, so that the boom was self-reinforcing. But the proliferation of companies intensified competition. Industry leaders lost their market position as a new generation of products was introduced because the individuals who were responsible for developing them left their companies and set up new ones. Instead of companies growing in step with their industry, the industry grew by the multiplication of companies. Investors failed to recognize this trend. As a result, technology stocks in general, new issues in particular, became substantially overvalued. The new issue boom culminated in the second quarter of 1983. When prices started to decline, fewer issues could be sold, and eventually venture capitalists became less venturesome. As fewer companies were formed and the existing ones depleted their cash, the market for technology products softened, competition intensified, and profit margins deteriorated. The process started to feed on itself, and the low point has probably still not been reached. P.S. February 1987, no longer true after the current explosive rally. All right. The venture capital boom was not the only cause of the subsequent shakeout. The strong dollar and the rise of Japanese competition were at least as important, but it is clear that stock prices had an impact on the fundamentals in both directions. What distinguishes the conglomerate and real estate investment trust sequences from the venture capital boom is that in the first two cases, the underlying trend itself was based on the exploitation of the investor's bias, while in the third, it was not. In the case of conglomerates, the idea was to acquire other companies with inflated paper. In the case of real estate investment trust, the idea was equity leveraging. The idea behind the latest generation of technology products has nothing to do with the stock market. To understand the ups and downs of technology stocks, we must know something about the underlying trends in technology. In the case of conglomerates and REITs, we need to know little else than the theory of reflexivity. It is important to realize, however, that knowing everything about underlying trends in technology is not sufficient to explain the ups and downs of technology stocks. The reflexive interaction between underlying trends, prevailing biases, and stock prices also needs to be understood. Combining the two kinds of understanding is extremely difficult. Those who want to be familiar with technology must follow the industry closely and continuously. Those who want to exploit the divergence between perception and reality must move from group to group. Most technology experts are ignorant of reflexivity and tend to remain fully invested at all times. Their popularity and influence wax and wane in a reflexive fashion. After the recent decline in technology stocks, a new breed of analysts seems to be emerging who are overly sensitive to the importance of investors' perceptions. After a decent interval, it may be once again profitable to go against the prevailing bias and invest in technology stocks on the bias of fundamental trends. I've always had a lot of difficulty investing in technology stocks because of the specialized knowledge required. Finally, I managed to gain a good insight into the computer industry during the 1975-1976 period and profited from the prevailing negative bias. I held on to my positions for a few years, but then I sold them and lost my grip on the industry. In 1981, I made the mistake of not participating in the venture capital fund operated by one of the most successful venture capitalists of the period, in the belief that the boom could not last long enough to allow investors to exit in time. In this, I was undoubtedly influenced by misgivings about the larger picture. In any event, his investors realized a good profit in 1983. By that time, I was totally out of touch with technology stocks, and the boom passed me by. Even the conglomerate and REIT sequences were not totally self-contained. Extraneous developments such as the level of economic activity, regulation, or specific events, the attempted takeover of Chemical Bank, played a crucial role in the conglomerate boom. In less pure sequences, the importance of outside influences is even greater. We are currently in the midst of another self-reinforcing, self-defeating cycle that will go down in history as the merger mania of the 1980s. Instead of inflated paper, it is cash that serves as the currency. Scale of transactions already dwarfs the conglomerate boom. Merger mania is but an element in a much larger ongoing historical drama whose ramifications reach far beyond the stock market and involve politics, exchange rates, monetary and fiscal policies, quirks of taxation, international capital movements, and many other developments. I shall make an attempt at unraveling the ongoing historical drama, but that is not as simple as analyzing a more or less self-contained boom and bust sequence. The larger picture is full of reflexive interactions as well as non-reflexive fundamental trends. We need a more complex model that allows for the transition from one boom-bust sequence to another and for the coexistence of several reflexive processes at the same time. Before I embark on such an ambitious project, I want to examine another market that is characterized by vicious and benign cycles, the currency market. And that is the end of chapter 2 of The Alchemy of Finance by George Soros. Today, that is what I did for today's live. If you want to learn more, go to yesfinanciallyfree.com. The replay is embedded there, as well as lots of blog posts. You can join the email list, put in your first name, email address into the right side of, if you're on the website, scroll down if you're on a phone, and then hit the big red yes button. You'll be on the email list, and you'll get the free ebook, Working Parents Guide to Financial Freedom, sent directly to you. Thanks for being on the live today. Have a great day. Aloha, and see you again next time.